This is a presentation, does not constitute tax, financial, or legal advice. Do not assume that anything said here applies to your specific situation. It's very important to sit with your attorney and CPA to answer your questions prior to moving forward. And this is for informational purposes only. Thank you for attending. So this is really about own nothing, control everything. When we own something, it can be taken from us. Putting it somewhere where you can control it is the most important. With proper trust structure, we have found that these three types of individuals benefit the most. First, for our property owners that are planning on selling. And this is just not limited to real estate. This can be for stock, crypto, or even the sale of your business. So any type of property that appreciates. If we are in the structure that we're currently in, we may find ourselves paying 50, 100, 500, $1 million in capital gains tax, where there could be a solution where you can get this set up prior to that sale and help you defer those capital gains. And we'll talk through that a little bit more. The second type of individual that benefits from this is the investor. The investors that are receiving passive income. This can be rental income, K1, or other types of passive income. It can really help them defer that, use that capital to invest in more, just have more to work with. And then finally, the business owner, that business owner that's actively producing income. Can't defer it 100%. You definitely take the sting out of it, 50 to 70, in some cases 90% or more, but it's really dependent on the current structure that you're in. Some structures work better than others, but we can work with all structures, S Corp, C Corp, LLC. Again, we'll dive into that in a little bit more detail. These are the ultimate benefits. This is really what it's all about. If you were to get proper trust structure with the type of trust that we're talking about today, you're going to have asset protection. You're going to have control of those assets, but most importantly, you're going to have control on your tax. You're going to decide when you pay that tax. It could be next year, it could be 50 years from now, it could be generations to come. So the few stories that I'm going to share with you are real life clients who are protected. These are not their real pictures, but we've protected who they are, but their scenarios are real. First one is a gentleman that purchased his house for a little under $200,000 30 years ago in the Bay Area here in Cupertino. He was selling his property north of 2.5. It was actually closer to 2.7. If he were to sell that property without this trust structure, he would find that close to $1 million would have been paid to the IRS. All he wanted to do was sell, buy something smaller in the Sacramento area to be with his remaining siblings. However, it was his primary residence. So 1031 exchange was out the window. There was no other option for him. So looking at this type of trust really put him in the driver's seat. He was able to hold on to all of that cash, defer all of that, buy something smaller, and invest the rest. The second client here, she sold her business. Now, her business was only worth, when she started it, her cost basis was quite low. She started for under $50,000. And so when she sold that business, or when she's looking to sell that business for, $7 million, the capital gains tax was just enormous. So we were able to get the trust created properly, implemented properly into her current structure, sell those assets to the trust that she controls, and that trust was the seller of the intellectual property, of the assets of the business. And so she was able to defer that capital gains. And in this process, she has since purchased 3 properties from the deferred capital, and she's converting those into assisted living centers. So a great strategy to deploy so you can hold on to so much more. This individual, quite a few clients in this situation where they have a corporation, they have net income, whether it be 100,000, 500,000, 3 million. For this specific individual, he had $800,000 in net income. He was able to get this structure set up during that tax year put specific contracts in place to implement it properly into his life and into his current structure. Without this structure, he was paying over $200,000 in tax. But now he's able to save closer to 70% a year. He's deferring that where he can utilize that, invest, buy more real estate, have more working capital, do what he needs to do for his business and for his family. And then finally, a few of my clients, they like to invest. They're investing in equity funds. They've invested in other businesses. Typically, as a limited partner, they've invested their capital. In this scenario, $250,000 invested in an LLC. We helped him structure, set up the contracts in order to defer that K1 distribution. It didn't get distributed to him. It got distributed to his trust. And from his trust, he was able to defer. So up to 90% on invested capital. So I'm going to talk through a little bit about how this compares to the 1031 exchange. I know some of our attendees tonight are property owners, maybe investors in commercial real estate and any other type of real estate you may hold. And, 1031s have been around for quite some time. If done properly, they're good. But we always run into those darn time stressors, right? And it's been said 40 in some other percentages, 40 to 60% of exchanges fail just because we don't check off all those boxes in time. That 45-day rule, 180-day rule, they really get in the way. And especially during a time where interest rates are high, inventory's low. You have to, you're selling at the height of the market, but then you're forced to buy at the height of the market. Seems like it's not fair. So getting rid of those time stressors, looking at this type of strategy, this type of trust instead, get rid of it. Get rid of the time stressors. You're not limited to like property. You can buy any type of property. This is not limited to investment properties. This can be for primary residence, commercial, anything that you're looking to sell in the real estate market. The equal to greater doesn't really play in so much here, where the value can be less and the remaining can be deferred. So again, looking at this strategy, being proactive, the only thing that gets in the way here is you must do this prior to selling the asset. If the asset's already been sold, we cannot unwind the clock. So this is a strategy that must be implemented. The trust must be created, implemented in your life, operated prior to the close of escrow. It's most important that this gets all done prior to the close of escrow. So there are 6 key provisions that are most important to talk about today, and we'll dive into each of these. First, it's a non-statutory trust. I'm sure some of us are familiar with the living trust. A living trust is a great place to start. It helps our family avoid probate, and that's a big deal. But that's all it does. There's a misconception that it gives any type of asset protection. And it's statutory, which means that you're required to distribute. So any type of trust that you see out there, a lot of them are statutory. They're set up in the state. They're a creature of the state. This is non-statutory. This is non-grantor. It's irrevocable. It's dual track, which means we can either use the complex tax code or the simple. Kind of going back to that non-statutory, this allows us to either distribute annually or not distribute and allow to grow and grow and accumulate. It's discretionary, and it also has a spendthrift provision. So let's dive into this a little bit. Non-statutory, we talked about this a little bit. It's not a creature of the state. It's based in contract law, but we have the right to contract. It's in our Constitution. We have the right. Nobody can step in between you and I if we wanted to write on a napkin that I was going to mow your lawn tomorrow for $20. Non-statutory gives you more latitude and flexibility, and it's set in contract law. This is a non-grantor trust. If you have a grantor trust, similar to a living trust, that means you created the trust as the grantor. You're the trustee, the one that moves and manages the assets, or you're the beneficiary, the one that ultimately benefits. And so what we call an alter ego trust is when you're acting in two roles. Our trust, you are not acting in two roles. You are not going to be the grantor of your trust. That's why it's most important to create your trust properly for true asset protection. So this is one of the keys to having asset protection, is making sure that you're setting up a non-grantor trust, so how it's created, but also how you're operating it. You do not gift or grant assets to this trust, or you automatically making it a grantor trust. This is a non-grantor trust. You sell. This is contract law. So everything has a bill of sale. It's irrevocable. There's a misconception that irrevocable means, oh man, I can never change anything in my trust. Doesn't mean that. It just means that if you have sold an asset, say a property, to the trust, means that that specific asset cannot revert back to personal ownership to you. But it does not mean that you lose control. You are the puppet master. See, remember the name of the game is own nothing, control everything. Talk briefly on this dual track. There are two sides to the tax code. Find it quite interesting that one is called simple and one's complex. It's all complex. I mean, they use double negatives to confuse us on purpose. But what we're talking about here is the simple tax code is statutory trusts. They must distribute annually. The complex tax code allows you to grow and accumulate your wealth. And it's up to the discretion of the trustee to treat his or her trust as a simple trust or a complex trust. Some of our business owners will implement a dual trust structure where one will use the simple tax code and waterfall and distribute into the trust that's using the complex tax code. And every tax year is different, and it's up to the discretion of the trustee on how he wants to operate his trust that year. And then finally, it has a spendthrift provision. Spendthrift provision is very important and one of the key provisions for asset protection. It means no judge or court may issue a turnover order on your assets. This is incredibly powerful. Making sure that you can hold on to your assets that you have moved over legally by contract. Now, it's most important to understand that you should move the assets over, sell the assets to your trust prior to any lawsuits, right? If a lawsuit's already been filed, that's a completely different story, right? You can't do after the fact. There's some cases, but 99% of the time, you want to make sure you're squeaky clean on that. So just talk briefly on active income versus passive income. I'm sure we're all familiar with this, but I like the visual, just explaining that if it's you or your company making the money, that's active income. But if the asset is producing income, that's passive. So with this type of trust structure, you can defer 100% of your passive income, but you cannot defer 100% of your active income. We can whittle that down, right? 50 to 70% with corporations, 90% with LLCs, dual trust structure could even be more. But again, just identifying and looking at what your current structure is would be most important, and identifying how this structure could benefit from you. And you've been invited by a consultant tonight. Please get back with them for any follow-ups or discovery calls, and we can definitely help you work through maybe your strategy. So we're just discussing the active versus passive. So when we're looking at passive income, these are the types of income that assets produce. Capital gains income, which we're all very familiar with, right? When we sell an asset that's appreciated, it could be real estate, your business, stock, crypto. Those all have tax. So capital gains tax, rental income when you buy and hold real estate, dividends and interest for some of your investments that you're holding, royalty income, maybe for a collection, art collection, and K1 passive for the investor. So these 6 types of passive income are not considered taxable right now, right? According to the IRS. So they're not taxable at this time. And you can continue to defer that as long as you operate your trust correctly. So I'm just taking an excerpt from private letter ruling and extraction from the Internal Revenue Code. This is the tax code 643. And the consultant that invited you tonight, definitely get the follow-up executive summary from them that lists the tax code and case law, gives more of the glossary terms that we went over tonight, the key provisions, and it will spell out a little bit more clearly as we're just going through a 10,000-foot view tonight. So 643, in the bold is what I'm going to focus on here. Items of gross income constituting extraordinary dividends or taxable stock dividends, which the fiduciary acting in good faith determines to be allocable to corpus under the terms of the governing instrument and applicable local law, shall not be considered income. Well, let's decrypt this a little bit. Items of gross income constituting extraordinary dividends or taxable stock dividends are these income streams here, which the fiduciary, which is the trustee of the trust, acting in good faith, right, doing everything by the book, determines to be allocable to corpus. That means allocated to corpus. Corpus is the Latin word for body. It's talking about the body of your trust where you hold your assets. So allocated to corpus under the terms of the governing instrument. You'll see the phrase governing instrument sprinkled through the tax code. It is referencing your trust contract, what is in your trust book, what it allows you to do. That's the governing instrument. An applicable local law shall not be considered income. So this is one of the key codes that our trust is built on. These are some companies that pay little to no federal income tax. There's some that have popped off, a lot more that have popped on. Said that close to half of Fortune 500 companies pay little to no federal income tax. They may be utilizing this structure that we're talking about here, but there are other structures they can utilize. But what I find is they already have firms swooning over them, right? But just because I don't have that many zeros behind my name doesn't mean that there shouldn't be a firm that brings Wall Street to Main Street. You know, this is where the big boys play. This is where they've been playing. We're just teaching them you to go play in the sandbox with them. So our trust is grounded in law. The Nexus Trust is written to comply with 8 different trust law categories and governing laws and codes. That'll be in the executive summary as well, a full list of them. Our trust is guaranteed to be compliant and consistent with the U.S. Constitution, U.S. Supreme Court, and other case law court decisions. And it conforms with all contract, trust, and tax laws in all 50 states. In U.S. tax court, where most tax cases are heard by judge or jury, there are less than 300 cases on record that have been heard since 1992 until today. And only approximately 75% of those cases had anything to do with trusts. And 100% of them were revocable grantor trusts. That's your typical living trust. And it's really just because you could pop in and out, right, whenever you deem necessary. So a lot of trust schemes can be created. However, there are 0 cases found involving our trust. If you'd like to talk further and really dive into a one-on-one, we can set up a Q&A session, call it a discovery call, and learn about you, your business, or how your structure is, the properties, what your pain points are, what your objectives are, and really look at building out a strategy that would make sense to deploy. If it all makes sense, you complete an intake form, submit payment to the corporate office. There's a rescission period, be 1 day, 3 day, 5 or 10 days. And once that rescission period is over, Then the attorney will pull the EIN number from irs.gov site, prepare your trust book, and it typically gets mailed out within 5 to 7 days from the point your rescission period is over. The trust books are delivered, FedEx delivery today. Get a tracking number. And once those trust books are delivered, then our team will help you activate that trust book. Activation is really important. It's really bringing the trust book to life, but it must be created properly. So our team will hold your hand through that and help you with your notary appointment. Once that's done, you'll be advised to go open up your trust bank account. You have one trust or two. You can open up multiple trust bank accounts. Typically, you'll do this at the bank that you bank with already, but you'll get some advice on some of the easier banks to work with and some of the harder ones. I'm with Luther Burbank Savings for my trusts, Wells Fargo, and there's some other ones that are easy to work with as well. If needed, you'll be introduced to the bookkeeper if you need bookkeeping services, and specifically to the CPA or enrolled agent to really talk through your trust strategy. So let me differentiate. When you do a strategy session in the very beginning, it's a 10,000-foot view of ways that you can implement your trust into your life. But after you have your meeting with the CPA or enrolled agent, they'll have their tax hat on. You can get more of your tax questions answered and see the tax implications on, and there may be a better contractor strategy to implement on that as well. So you'll be able to get that information, you know, as you go through this journey. Once that's all done, then at that point, the team will help prepare any contracts, bills of sales, maybe it's modified operating agreements for your LLC, whatever contracts need to be put in place to legally move money or assets from one entity to the other will be prepared. And then you'll set up a second notary appointment to notarize all those. And once that is all done, then you are benefiting from the Spendthrift Trust.